Passive or non-passive? Get this wrong and your whole tax plan collapses. You can have the best real estate deal, the perfect LLC, and still pay too much in taxes, all because of one rule most people don't understand. It's the IRS definition of passive versus non-passive income, and it decides whether you get to take deductions that save you thousands or do absolutely nothing. The IRS divides income into two big categories. Passive income, which are things you invest in but don't actively manage, like a rental property or a limited partnership. You might call this mailbox money. And non-passive income are things you actively work in, like your business or self-employment or other earned income. Now, here's the key rule. Passive losses, like real estate depreciation, cannot offset active income from your W-2 or business. So if your rentals show a paper loss, that loss just sits there until you either sell the property or you have other passive income to offset. I've been a CPA for over 20 years, and I've seen many people go out and buy a long-term rental property thinking that they would be able to deduct those losses against their W-2 or other business income, and it's just not as simple as that. So before you make a purchase, you need to talk to your tax advisor and make sure this is going to work for you. So there are three main ways to unlock these losses. Number one is the special $25,000 allowance. If you actively manage your rentals and your income is under $100,000, then you can write off up to $25,000 from your rentals. Now, between $100,000 and $150,000, that's going to be reduced by 50 cents on the dollar. So this is a really good way for you to start out on your real estate venture. Number two is the short-term rental loophole, which we discussed in a separate video. But basically, if the average stay in your rental is 7 days or less, then you may qualify for the short-term rental loophole. Be sure to check out this video and make sure that you satisfy all of the conditions. Now, number three is real estate professional status, or REPS. Now, this is not a real estate agent, but it is someone who works in real property trades or businesses. If you spend 750 hours working in a real property trade or business, and that is more than 50% of everything else that you do, then you can qualify for this classification. The key to both of these last two is material participation. This is what tells the IRS if it's passive or non-passive. Please watch our video on material participation to make sure that you know the rules. When you know which bucket your income belongs in, passive or non-passive, you can plan your entity structure, your property strategy, and your hours around it. And that's how my clients go from guessing at tax time to knowing exactly how to reduce their tax bill every year. Now, let's clear up a couple of common myths. First of all, passive just means you don't have tenants. This is not true. Think again of your mailbox money. You don't really participate in any activities to have that check coming in every month, so that is passive. If that's pretty much all you're doing with your rental property, then the same applies. Number two, hiring a property manager still counts as active. Not usually. If you have a property manager, especially a full-time one, that means you're probably not putting in enough hours to be considered non-passive, especially with a short-term rental. But everybody's case is different, so make sure to contact your tax advisor. The third one, you can just claim real estate professional status. Well, that's not true either. You must prove your hours. We'll talk more about this in a later video, which is coming soon. Understanding the difference between passive and non-passive income is step one to real estate tax strategy. Next, we'll dive into the rules that actually determine if you qualify, the material participation test, and how to prove it on paper.